I mean, he very well introduction. Sometimes it's good to know yourself from others. So as he said, I have been working in mutual fund industry for almost 36 years now. And first 15 years I was with Unit Trust of India, the organization which introduced the mutual fund industry to the nation. I am very proud about it. Last 18 years I have been working with SBI Mutual Fund, the largest mutual fund of the country. I am really very proud about it. For last 9 months I have been working with that time youngest AMC, the Wealth Company Mutual Fund. I will be proud of it, I am sure about it, and I will also help investors to generate wealth through the Wealth Company Mutual Fund different schemes. So little about the group. The Wealth Company Mutual Fund is owned by the Pantomath Group. Pantomath Group was founded in 2012 by husband and wife, Madhu Lunawat and Mahavir Lunawat. Madhu takes care of the AMC, she is a rank holder CA. Mahavir is a gold medalist company secretary, and he takes care of the other merchant banking businesses. So put together, the Pantomath Group is managing almost 10,000 crores of AIF, which is a category 2 AIF, which is invest into unlisted companies. Then they also acquired the business of Asit C. Mehta, which was owned by Dina Mehta. I don't think anybody needs introduction to Dina Mehta. She was the first lady president of the Bombay Stock Exchange. I think the next generation was not interested in the business, and they acquired this business also. So now the Pantomath Group has 3 verticals, institutional retail, AMC, and then the merchant banking division. So when we started, we were the 49th AMC, the youngest one. The big daddy, I mean the heavyweight mutual fund was just before us. You would know whom I am referring to. And in the first season of funds, we garnered almost around 2,000 crores. So by that AUM, I think that was a unique achievement, because none of the young AMC had garnered 2,000 crores in the first series of the funds. So by that we became 42nd, or maybe in next few months we would climb the ladder. Of course, your support and your help will be all required. As I say, we are here only because you have supported us, and I think you will continue to support us. Kind of work we are doing at the Wealth Company Mutual Fund is really very different and very seasoned. Why I am saying so? All the departmental heads, all the division heads at the Wealth Company Mutual Fund have at least 20 years of experience. I am there as a CIO equity, have worked in I don't know anything beyond mutual fund industry, so I have worked almost 36 years in the mutual fund industry. My colleague CIO fixed income, he also comes from Franklin Templeton, who has 20 plus years of experience. Our strategy officer, you would have met him, Debashish Mohanty. He has also worked in the mutual fund industry, 35 years in Unit Trust of India. Kumar is here, I think he has also worked in UTI for almost 35 years. So I think, there is the kind of a depth we have, and then the veterans we have, and then the seriousness and commitment what we have towards the industry, I think it's unparalleled. No other young AMC has that kind of a depth. I'm really wanted to bring that to you. This I spoke about. We have 3 different verticals. We also talk about our trustees. They are also very seasoned people. They have been, most of them, out of 4, 3 are IAS officer, 1 is IRAS officer. And then you can understand, if you don't have a confidence in a new company, these people will not lend their name and experience to that company. I think that talks a lot about it. Then even the AMC board has veteran people. Mr. Atul Joshi, apart from Madhu Lunawat, Mr. Atul Joshi, who was working with Fitch for many years. Mr. Hemant Bhargava, who has worked with LIC of India, I think for almost 35 years. And Mr. Chhatrapati Shivaji is also a new addition to the board. They are all seasoned and very experienced people. This is our investment team. Prasanna also has 20 plus years of experience. He was his last stint was as a CEO of Taurus Mutual Fund. Debashish Mohanty I spoke about. Mr. B.Y. Joshi has also worked in a mutual fund, and he is the backbone of the Wealth Company Mutual Fund because he looks after operations. Suruchi Vandre is our Chief Compliance Officer. She has also worked with UTI for almost 35 years. Umesh I spoke about, and that's me. I will, since I think we are meeting for the first time, so it is important to understand what is the investment philosophy of the Wealth Company. So when I joined a few months back the Wealth Company, little background about me before that. I joined SBI Mutual Fund in 2007 as a research analyst. I was tracking capital goods, engineering, textile and cement as sectors. And in 5 years time, I started managing the funds. I started with an international mandate. I was managing advisory and discretionary portfolios. Then we launched the first ESG thematic PMS in 2016. I was managing that from the day one. I also managed sectoral funds, and then the last strategy which I was managing was for the MENA region investors, Dubai plus countries, which was a multi-gap strategy. I have been managing funds from 2012, so I am kind of in effect managing for more than 13-14 years. And the way the kind of learning what I have ingrained at SBI Mutual Fund is what I am bringing it to here to the new company. The processes and the systems what we developed, I was part of that, what I implemented in the portfolio, and which gave performance was good as an outcome of those processes. I am bringing it to the new company, the Wealth Company Mutual Fund. So if you look at, if I see the way when I started managing the funds, that time even the buy and hold strategy was still in vogue, it was still in fashion. You could buy Asian Paints and stay invested for many years and make loads of money. After some time, I started realizing the portfolio's construction or the investment strategy is undergoing a change. You can't even think about buying a stock and staying invested for 3 years without looking at it. That was not what was happening. There were a lot of changes which were happening. The businesses were undergoing disruption. The disruptions were very fast and quick. And then the businesses, if you were thinking about those businesses, they are kind of foolproof businesses, they were undergoing a lot of change. So change was the only constant, and when I joined the company, new company, I said, okay, we'll make this change as a base investment philosophy of our portfolio management. Why it is important? Because everything is changing very frequently, and you have to be agile to understand the change company is having and what is that impact on your portfolio because of those changes. And you have to be you have to take an action also quite quick, otherwise you will be just sitting ducks and buy and hold strategy is not working now, and then you will be underperforming a lot. So we have attached an important factor to every alphabet of the word change. The C stands for the capable management. I believe that management is the most important mode, a critical factor in any business for a growth trajectory. So management is important. Then the historical performance. It talks about how the company has behaved operationally, financially in the last few years, and that is a guiding factor for the future. Then the attractive valuation. When you are entering a stock at a reasonably right price, the potential of you generating better returns is higher. So you have to be very mindful and careful about at what price you are entering a stock. And then the navigating the business across multiple cycles. I mean, I have this example of airlines industry. Look at the industry. There were a few more companies which were existence into before COVID. What the COVID made, it was a great teacher. But there was one leader which changed its business cycle. What did they do differently? They increased their cargo belly. They made the capacity where they were carrying the passengers fungible to carry more cargo. That's how they survived and prospered. Maybe this was an obvious thing. Now, if you look back, we feel that it was so obvious, but none of the companies thought about it. It was only the leader, it was only one company which is a leader now. And then the governance. We are investing in a company as a minority shareholder. Not more than 10% is what SEBI says. So, but it is important how the majority shareholders have treated the minority shareholders. I believe, like, human being, companies are also entities, and as human beings DNA doesn't change, a company's DNA also doesn't change. So it is important to look at how this has behaved in the past, and that helps to avoid accidents which may happen in the future. Then the last E is about earnings growth. It's not only about history, it is also about the future. So you have to have a better visibility or more confidence about the trajectory of the company, and that is what it makes about the change. And then there is an overlay of age. Change is all about internal factors, what happens inside the company, which is more controllable by the company, but it is not, a stock doesn't perform only because of the internal factors. It also, there are external factors which impact the stock performance. So there is an overlay of age. Exchange related factors like price change, volatility, domestic factors like interest rate, GDP growth, or global factors like FI inflows and outflows. Look at a private bank leader, gold standards of business. The company has been doing really well, business has been growing, but the stock is not performing because the FIIs have been selling. So what is the shareholding is also important to look at. And then the last E is the exit or rebalancing. We don't want to get stuck in a stock. That is why at the time of entry, we have to be clear when to exit a stock, when to rebalance, when to trim, when to size up. If you are clear about that, then lot of mistakes you can avoid and you will not get stuck, because we see that fund managers usually sometimes get stuck in a stock willingly or unwillingly. So this is the investment philosophy. It's an organization level philosophy. So if I am there, if I am not there, if somebody else is there, this will be the philosophy which will be followed by the whole investment team, and that has consistency and sustainability and longevity of the investment philosophy. Investors should not worry about if you leave or if this fund manager leaves, what will happen to my fund. I think the investment philosophy, if it is an organization level philosophy, it talks a lot, gives that kind of a confidence. There is a kind of portfolio construction funnel. We look at 5,500 listed companies because we don't want to miss any opportunity. But based on the combination of factors which are quality, value, growth factors subdivided into 12, 13 more factors, we filter the universe of 5,500. We come to 400 companies. That means the rejection ratio is so high, it's almost 92% companies are rejected through our filtration process. Why it is important? Because we are more of a risk manager. We want to not to make many mistakes. We want to avoid many mistakes, and then the path of a better risk adjusted returns will follow. So that is the process we follow. We add momentum as a fourth factor after we come to a 400 stocks. Okay, based on the different factors, we score them. And we focus on top 200 to 250 stocks. Okay. Here we wear an analyst hat, we meet the management, we do the competitive analysis, we do all the channel checks, and depending upon a portfolio strategy, we build a portfolio of almost around 40 to 50 number of stocks. Why 40 to 50 number? Because that is the ideal, lot of research suggests that is the kind of an ideal number for diversification benefits. If it is less or if it is more, actually hurts the portfolio performance. So this is and that is what my experience also talks about. I have been managing the funds in this kind of size only, almost around 45 number of stocks, and that had done good. So 2 months back, we had our first launch, FlexiCap, the wealth company FlexiCap fund, and I'm really happy at how the portfolio is getting, built. Just small information about the fund. How are we stocked at? When we were launching FlexiCap, we said that we will be, optimally diversified. That means we will have 40 to 45 number of stocks. We are currently at 40 number of stocks. We will be more agile for maneuvering between different market caps, and currently we have almost 54% into large cap. We are holding 7-8% cash because we could see there were a lot of IPOs which were coming, and we had the advantage of applying for that at a 8-9% of the portfolio. So we were leveraging on that, and we are happy that some of the 1 or 2 IPOs we did not apply, which did not do well, but others where we applied, we were very quickly, you also book profit by selling in the frenzy of the listing. So that's why the cash is little higher, but as the market stabilizes, I think we will come back to 4-5% of a cash, and the portfolio construction, the fund has, of course, the 2 months time is a very short time, but the fund is only in existence of 2 months, so I can only show what is available, but it is, it's a good start for the journey, long journey what we have ahead. I think that's why I felt this is important to showcase. Then last month in 45 days we launched another fund, multi-asset allocation fund. Here also we try to map competition. There are almost 38 products available. Out of that, 29 products are equity heavy. Okay, Ankit talked a lot about gold, silver, precious metals, commodity, how you should have a ETF product as a component of investors' portfolio. I think multi-asset allocation fund gives you everything in that one fund. I think this is the classic product. Of course you would be doing it, but you should have this as a first fund if an investor is not exposed to equity yet, and because through multi-asset fund that investor will get an opportunity to understand the dynamics of the equity funds. At the same time, there are precious metals, gold, silver, and REITs, another important asset class, which can give a stability to the portfolio. So, as I was saying, there were almost 28 funds which are equity heavy. What it means that they can invest into equity minimum 65%. When you invest 65% minimum, we don't want to breach. So we usually have 66-67% into equity, 3-4% into cash. That means 70% is gone out of your horizon, and 15 to 20% into fixed income. That means 85 to 90% you are invested into fixed income and equity. But if it is a multi-asset allocation fund, it should have a wider, kind of a flexibility. But that balanced 10% is not going to give you much flexibility. So we chose to be into second category, where we have to invest only 35% into equity. That leaves us a 65% 65% of the portfolio to invest into other 2 important asset classes. We believe that multi-asset allocation, when SEBI says you can invest into minimum 3 asset classes, all these 3 asset classes are equally important. So your starting point has to be that you are looking at all these asset classes with equal importance, and that's what we are doing. So we'll have a view on the gold first. We will decide how much allocation should go into gold, and then we move to the silver, and then the REITs, and then we come to equity and fixed income. I think that gives us a lot of flexibility to invest into the precious metals if it is going to be really faring well, and even if equity falls a lot, and then there is a scope to invest into equity from 35 to 65%. Another thing is that lot of investors will already have equity funds. So if multi-asset allocation is also going to be equity heavy, there is very less differentiation. So it is just replication or duplication of the funds. If you look at the portfolio, they would look similar. So there is no advantage of diversifying across the different categories. So that's what we felt, and that's why our, our intention was to give a product to the investors which is different and which is true to the label to the multi-asset. I think multi-asset allocation strategy is very much popular, so I don't have to go into the nitty-gritties of the fund. But we have if you look at last 16 years, okay, out of this 16 years, 9 years, gold has done phenomenally well. It has been a top performing asset. Then equity has been top performing for 5 years, 5 times. And even fixed income has done well in 2 years. So what it is saying, it is not just one asset class which keeps performing across the time periods, but it's a combination of asset class, as even Ankit was mentioning, that gives you a kind of a confidence, and the stability to the returns and lower volatility is what this multi-asset allocation fund brings to you. All these asset classes are why they are chosen, because they have a low correlation to each other. Look at gold and equity, it is actually minus correlation, minus 0.04. Means if gold is going up, maybe equity will not go up in the same traction, but when equity is going up, even gold will be stable and give you that kind of a stability. We also try to do some analysis around what has been the maximum drawdown, or what has been the kind of returns. So if you look at last 30 years, the Sensex return had been around 10.5%, while the gold has given 11.5%. And if you remove that last 1 year's 100% returns, the returns are almost similar, 10.5 and 10.1. But this is not what is important on this slide. The important thing is that maximum drawdown. Equity had fallen by almost 60%, but the gold had fallen only by 20%. So that is the most important factor on this slide, and look at even standard deviation, which is lower for gold, and that is why it has to be an important part of your portfolio or all investors' portfolio. Multi-asset allocation fund is multi-asset allocation is not only popular or giving results in India, but it is also giving, it has been followed by many bigger countries also. Look at US, UK, China, Japan. In their local currencies, multi-asset strategies have done much better than just pure equity. This is about, how tax efficient it is. Of course, this is just for the sake of bringing that difference to you. Usually we talk to any investor, if it is an equity investor, that minimum 3 years or minimum 5 years has to be investment horizon. So this the differentiation is between 1 year and 2 year. If it is equity heavy fund, then you will get a taxation which is if you are holding more than 1 year. But if it is a hybrid kind of a fund which we are having, you have to hold more than 2 years to get a capital gains tax at a lower slab rate. So this is what multi-asset allocation fund offers: the flexibility, the resilience, and then the combination of multiple assets. There are multiple factors, and the most material factor or the most important factor for anything in the world is demand supply dynamics. Look at any stock. If the stock has, if some institutional investor enters into a stock, a large chunk is held by the institutional investors. If there is a less retail participation, the stock has tendency to move upwards. That is what is happening into gold prominently. What has happened in last few years is that the characteristic of the owners of the gold as an asset has changed. It has become more institutionalized. Why? Because one is that there is a fight which is going on between the two superpowers, and also there is a lower confidence into US. So all the nations who were holding their treasuries into US currency are moving away. So where they can hold this, shift the currencies is, the treasuries is into other currency or some asset which has, store value, which is gold. Other currencies, they don't have faith in China, they don't have faith in UK, they don't have faith in any European country. Russia, forget about it. So everyone, all the countries have started taking out money from US currency, US dollar, and started buying into gold. Okay. So that is what is happening. That means these central treasuries which have bought gold, they are not going to come back to the market if gold goes up by 10% or falls by 10%. So that almost 1/3 of the production, usually annually I think 3,000 tons is produced. Last year central treasuries bought almost 1,000 tons. So 1/3 of that production stock has gone into locked into central treasuries, keys thrown away in some sea, and it's not going to come back. So 2/3, 1/3 is, I think, again held into ornaments and other kind of assets. That is also not going to come. And then additional demand is coming from ETFs. When you buy an ETF fund, the ETF fund house has to buy equivalent value of gold and store it. So again, if you are, even if it is 2-3% of the whole consumption, that is also putting pressure on it is shrinking the availability of the gold. And as he was saying, even I totally agree to that. If there is a low supply, even small prices will take the asset prices higher, or at least they will stay at elevated levels. So what is going to change? Political scenario, is it going to change in next few years? We know once war is started, it doesn't go. We just only stop talking about it. We have forgotten Russia, we are talking about US, China. After few years, we will forget about this also. But then central treasuries will keep buying gold. Okay, and silver, it has more industrial usage. That's why again the production is lower and constrained, and that's why little higher usage also will take silver at a higher rate. So that is all about multi-asset allocation fund. We have reopened the fund. We have started deploying, and we were almost 4% into silver, almost 8% into invested into gold. We have 3% into REITs, and almost 50% of our equity allocation is already invested. We have a methodology to define or to help us to devise how much allocation should go to which asset, which is a methodology. Two major factors are relative momentum of every asset class against its own history. Second is that relative momentum against another asset class about I'm talking about gold to equity, gold to silver, this kind of a relative momentum, and that helps to devise a allocation. So currently that methodology is suggesting we should be around 38% into equity, 40% into fixed income, 20% precious metals, maybe around 15-16% into gold and balance into silver, and then the 4-5% into REITs. I think that's what we are following, and we will rebalance this on a quarterly basis, but that doesn't mean that we will sit idle. If there are kind of black swan kind of movements, we will be more agile to change our methodology in between, and if it is not required, we will not rebalance just for the sake of rebalancing, because every rebalancing will have a cost to the investor. So that is how we are working, and it's really very short period of time, because 12 December was the first NAV which was declared, which was last Friday. Maybe from next week I will start getting 1 week performance, but that is really very short, and the portfolio is getting constructed. Our gold ETF fund is open for subscription. If you want to directly come into gold ETF, that is also there. We also have a product there. And I will stop here. There are many products which will be coming. We are just waiting for this month to get over and people to start coming back to their normal working style from maybe mid-Jan. We want to have a full bouquet of products. So investor has a full bouquet and they have a choice to decide where to invest. Thank you. Thank you so much.
Allocation, multi-asset allocation, and also some perspective about currency markets. So it's time for R. Devi to honor Ms. Aparna, who is the Sri Devi of financial markets. I think